Good evening, everyone. Welcome to In Plain Talk, Crop and Livestock Insurance and Risk Management Strategies webinar series. Tonight's guest will be talking about insurance tools for urban, organic, and specialty crop producers. This webinar series is brought to you by USDA Risk Management Agency and Annie's Project. And the Risk Management Agency award number is RMA 23 CPT 00-13617. And I just wanted to take a few minutes to tell you a little bit about Annie's Project. Annie's Project is a 501c3 organization whose mission is to empower and educate really anyone in agriculture that is interested in learning more about risk management. Our primary audience is women, but we are open to anyone who is interested in learning more and improving their farming operations. We have 38 states that we have facilitators in, and our facilitators are our boots on the ground that deliver our educational programs. But we do have participants that come from all 50 states. And we're so excited to have you here tonight, and we hope that you enjoy learning more about specialty crop insurance. So I'll turn it over to my counterpart, Doris Mold, and she'll introduce our guest tonight.
Good evening, everyone. Thank you, Carisha. I'd like to introduce Dean Strasser. He is the Senior Vice President, Program Analysis, Research, and Regional Services at NCIS, in other words, National Crop Insurance Services. Prior to his current position, he has been a crop insurance specialist, training and education specialist, director of field services, and vice president of insurance services and operations for NCIS. His NCIS journey is highlighted by the crop hail and federal crop insurance adjusting presentations he developed, actuarial change presentations, and being the main point of contact for federal crop insurance adjuster licensing and writing whole farm revenue protection magazine articles. Boy, he's done a lot of work. He's also been involved in supporting the NCIS regional state crop insurance committees and has looked at that as the most rewarding aspect of his NCIS career. Dean has a background in production agriculture, retirement investments, life and health, and property and casualty insurance. He received his BS in agricultural economics from Kansas State University and hails from Scott City, Kansas originally. So welcome, Dean. We're thrilled to have you with us here tonight.
Well, thank you. Yes, it's you look back on what you've done in your life, and you sometimes when you get caught up in the daily task, you just kind of forget that you did have some things that you've accomplished in your life. So let me share my screen here so we can get started with this. So let's get started here. Just looking at the topic here, we see that we've got insurance tools for urban, organic, and specialty crop producers, and so many of the federal crop insurance products really don't have or aren't tailored to some of the specialty crops because there's just so many different crops that could be insured out there. It's very difficult to get the data necessary to offer a program and everything that's necessary that RMA would need to offer such a program. So that's where the programs that I'm going to speak to you tonight come into play, and that's the whole farm revenue protection and the endorsement that you can get called microfarm that has some very interesting and probably very attractive type of features that we'll discuss. So with that, this product, the whole farm product, it really doesn't care that there's another product out there. It doesn't care whether you're producing vetch or alfalfa or navy beans or anything like that. It covers everything that you might produce on your farm. So let's get into this a little bit more. So again, I've already seen this slide is just an informational slide about the agreement number that this presentation is operating under. And just one of those things that we're trained to include in all of our presentations. This just a disclaimer that if your host, myself, misspeaks, that anything that I say, if it's in violate or in not lined up with the policy or procedures, those will take precedence versus what I tell you. But hopefully, I am accurate in everything I say tonight, and we don't even have to worry about this. So again, what are we talking about? Whole farm revenue protection in the microfarm program. So again, getting back to the opening slide, talking about organics, the whole basis of this program is to set up what are your expectations of your farm, and as far as those kind of things, we'll get into those. So what are we going to do? We're going to create an understanding of the benefits of what these programs offer and how they might work on your farm. We're going to talk about the basics of these programs and also the coverage that these programs provide and the documentation required by the program. And I understand that some of the prior sessions have talked about record keeping. Keep that in mind. I know this program has some neat documents that I think back to my folks' farm and my brothers, they farm too, and some of the records that they keep, and just a lot of the things that they do would basically these forms are asking for that information. So we'll get into that a little later, but let's just keep going. So the basics, some of the things that we need to talk about is what's the jargon we're going to use. Crop insurance, federal crop insurance has all kinds of acronyms. This program and other federal programs have their own set of jargon. So we'll try to explain what that is, some of the terms that we use. We're going to briefly show you what's on the RMA webpage, because if you're really curious about this product, they have some very good information. It's, they have a whole farm revenue page that just walks through frequently asked questions. What can you expect? What does it cover? What does it not cover? Those type of things. And we'll touch on some of that. Where is it available? Well, the better question is, where is it not available? There might be one county in the entire United States, and that includes Alaska and Hawaii. So it's virtually everywhere. Eligibility, we'll talk about what is required to be eligible for the program. In a sense, is what do I have to qualify for as far as signing up for this program? There are some record requirements as far as your tax reporting and things like that that make come into play for that. The coverage and limits, we'll talk about those. So before we get into too deep, we'll talk about the type of farms that these programs were designed to cover. We'll walk through the insurance cycle. That means what time of the year do you come in and talk to an agent? What's the reports that are necessary to do that? And then the claims and how that all flows. And then finally, the details. We'll get into the paperwork. Oh my gosh, the paperwork. And people think, well, Whole Farm's got a lot of paperwork, and I'll tell you what, I had to help my daughter qualify for an apartment in New York City, and this is nothing compared to the paperwork that I was required to do to sign as a guarantor for that. So just keep things in perspective, but we'll walk through, this program is going to require a Schedule F. It's going to require what's a farm operation report. That's basically your application. It's what is going to happen on your farm. What do you expect is going to happen on your farm? The whole farm history, basically a look back in time at what has happened on the farm in the past few years. Allowable revenue. There's certain things that are reported on the Schedule F that just are not allowable. And there's other commodities, or say if you've got some forest in your on your property that's just there. Well, forest is not insurable. So we'll talk about insurable commodities, that type of thing. And approved revenue is after we've gone through the mill of identifying what's allowable revenue to count and those kind of things. Then we come up with what the guarantee is. And then obviously, if we've got some inventory that we're carrying over from last year, we want to make sure that we keep track of that. And because it was produced in a prior year, and we want to make sure that we keep track of that so we don't count it twice when it comes claim time. So you don't want that. Replant qualifications, just want to get that. Sometimes we have a Mother Nature gets the best of us early in the year. We've gone out and planted something and it gets wiped out or gets flooded. The microfarm portion of this, the endorsement to the whole farm does not provide replant payments, but the whole farm product does. And then claim submission. So let's keep going. The jargon. So I know this is a lot, and I'll try to explain them as we go through. Hopefully I'll remember to, instead of just using the acronym, I'll say what the acronym is. But the Crop Insurance Act, that's what is the basis for federal crop insurance. It's codified in the regulations. The AIP, you'll hear that term anytime you talk to an agent. That's the approved insurance provider. There's 12 or 13 of them that have an agreement with the federal government to offer these products. Ag marketing service, that's good to know because a lot of the prices that the insurance providers will look at what you have provided. They'll kind of measure those up against what AMS reports and try to make sure that things are in line. FCIC, simply that's the federal crop insurance. Farm operation report is the FOR, FSA, Farm Service Agency. Some of you might be familiar with them. Hopefully you are. Intended farm operation report, that's the first thing that you'll fill out when you come in and meet with the agent. That's basically your farm plan. What are you going to do this year? IRS, Internal Revenue Service, we use the Schedule F. MPCI is a common term in the federal crop insurance. That just means multiple peril. Rather than I deal with the private crop hail, which is a single peril of hail. Just kind of differentiate. That gets pretty deep into insurance speak. NAP, that's the FSA Non-Insured Disaster Assistance Program. And one of the things that having this whole farm program is that you can also have NAP, or you can have another, say if you have wheat and you have a wheat policy, the APA or the yield protection, you can have these two products together and they'll work in tandem. The pair, that's the pre-acceptance inspection report. That's for perennials. So if you have a few apple trees out there or pear trees, or you have an orchard, that's the inspection report that the adjuster will come out and look at the trees and make sure that it's acceptable. Pre-acceptance worksheet, that's what you'll fill out, kind of what is out there, how many trees do you have, that type of thing. Again, it's a perennial form. Purchase for resale, that's a big one. So if you have a roadside stand or whatever, and one of the things that comes up is you want to offer a wide variety of vegetables and fruits, but you do not grow all of them. So you might go purchase some to round out your offering. And we are just looking at what the basis is for those. So what did you pay for them? What did you sell them? And it's that difference that's the expected amount that we're wanting to cover from insurance perspective. Production reporting date, essentially that's when do you report at the end of the year what you did. That's something that's primarily applicable to other insurance plans, but we do get into it in the whole farm product program a little bit. Revised farm operation report. As you go through the year, things change. Maybe you planted more soybeans than you intended, and it provides an opportunity for you to come in to the agent and say, hey, I put in another 30 acres of soybeans. So we want to revise that and capture that information. Sales closing date, basically, when do you have to go in and do all of this? Special provisions, that's you get on the RMA website, and that's all of the, we keep hearing about the fine print. That's the fine print. But this isn't as fine a print as maybe a health policy or something like that, or your auto policy where there's tons and tons of fine print. There's plenty of it. I'll give you that. But THC, that's that Delta 9. That's when we're talking about hemp. Hemp is insurable federally, but marijuana is not. Whole farm history report, again, that's what happened in the past. And then just WFRP is the standard acronym for the product we're talking about. Commonly used terms. I know we'll just touched on a couple of these, the allowable revenue, the approved revenue, beginning in accounts, ending accounts receivable and payable. So we didn't talk about the receivable earlier, but what have you grown in the year that you have not yet received money from? It might be in storage. You've got grain in your bin, and you have not yet received payment for that. So we'll have to put a value on that. Beginning and ending inventories, commodity. What's the crop you're growing? Expected revenue. This is the crux of the plan. This is what do you expect to produce in the coming year? What is the expected value of each commodity? Are you going to sell apples for $18 a box, $10 a box? Do you have different varieties of apples? Maybe you have a Cosmic Crisp that's going to be $24 a box, and your Red Delicious, you might only expect $8. So want to make sure that you're keeping track of those type of things. So that gets into the record keeping that you've probably talked about before. Expected yield. Now, this is an interesting one. If you have a lot of commodities, you're growing on the same acreages, there are some tools that allow you to just state what a revenue is for that particular plot of ground rather than trying to figure out, okay, I've got 400 square feet of strawberries. So we're not going to break it down into a per acre. We're going to look at maybe what it is per that plot of ground. So those are kind of things that get real into the weeds, but it's something that you need to be thinking about as we go through this. Market readiness. What does that mean? Under the whole farm product, if you've got a commodity, say apples, and once you pick those apples and they leave the farm, any type of revenue or expenses that happen after those leave the farm are not part of the equation. So if those apples are taken and they're being sliced and it's adding a value to that, say they might have come off the farm at $18 a box, but once they get sliced and packaged, they're worth 24. We're going to use the $18 because that's the term, that's the point at which we're looking at. Market readiness means what is the minimum amount of cost or whatever to get them ready for market. So if we're picking lettuce in California, right there at the edge of the field, they've got trucks, they've got washing stations, they're wrapping them in plastic and putting them into crates. So that's market readiness. It's the minimum amount to get them ready for the market before they leave the field type of thing. So post-production operations, that's kind of just what I explained. It's just kind of a long way to explain what that term means. Produced, just what it sounds like. What did you produce? Um, so Schedule F or substitute Schedule F, if you have an entity type that is not requires a Schedule F to be filed along with your 1040s, then you'll do a substitute Schedule F to just kind of give us the information that's necessary there. Verifiable records, that's simply records that a third person can come in and say, yeah, these match up with what you're telling us. whole farm history period, we've gone over that before, and then the historic average revenue. And this is where we're looking back in your history. What is your average revenue on a year-to-year basis? So that's what that means. So that's a lot of stuff to take in, and I know it'll mean more later, hopefully, if I do my job correctly. So let's look at the RMA website. And so if when we're all done here and your everything's rattling around in your head and you can't quite get a grasp of what everything I talked about, I would encourage you to go back to the RMA website, rma.usda.gov, and there is right on their homepage down, just scroll down a little bit, and it says whole farm revenue protection. You click on that, and it brings up all kinds of fun stuff. Frequently asked questions, the current policy, the handbooks that all of the approved insurance providers are required to follow in the administration of the product. So it's all right there. It's all transparent. Nothing's hidden. There's also a record aid for direct marketers, talked about the necessary evil of keeping records. This is just a down and dirty, you can fill this page out. What did you take to the market? What did you sell? What was the revenue from that uh, commodity? It's got several lines for all the different things that you take to the market. And then it talks about improvements to the program over time. What has changed? What are the lessons learned? What have SARMAID learned, and how they've improved these products? The microfarm has gone through several enhancements in the past 3 years, so it's kind of interesting there. And then some producer perspectives, just how are the existing producers, how are they utilizing this product? So it'll give you an idea of, someone that's using it, how's it working for them? So covered this briefly. Where is it available? Guess the question is, where is it not available? Makes perfect sense there. I think there's one county, like I said, in the entire United States that it's not available. And I think that's probably a county that's made up of just mountaintops. Okay, so let me take a breath here and let's talk about who the product is designed for, and we'll walk through the insurance cycle. So when I do these presentations, it's pretty difficult for me not to get too deep in the weeds. The policy itself is 55 pages long, and it takes a while to read through all of that government speak and try to figure out exactly what's happening. But hopefully, I've done that all for you and condensed it down a little bit and make it understandable. So, with all of that, I mean, you're going to be overwhelmed probably at the end of this. So, before you think about the purchase decision, go talk to an agent and tell them about your farm. What do you accomplish through your farming operation? Do you have livestock? Do you have specialty crops? Do you have grains? What are your marketing objectives and goals? How do you market your crops? And all of that kind of thing. It's just like wanting to make sure that you've educated the agent about what your operation is all about. Don't want to make the agent guess. So, with all of that, whole farm is unlike traditional crop insurance because it covers every commodity produced or purchased for resale on your farming operation. Traditional forms of crop insurance are on a single commodity basis. We already talked about maybe having a wheat yield protection policy. You might have a dry bean policy. You might have an apple policy or a cherry policy. This rolls everything up under one umbrella. And some people actually refer to this as an umbrella policy when they have other policies, maybe for their apples and their dry beans and corn and wheat and things like this. This will sit over the top of all of those. It's important to understand that the definition WFRP, Whole Farm Revenue Protection, considers produced. It defines produced as follows. An insured commodity will be considered produced when it has matured to the extent that it is generally sellable at established markets, regardless of whether or not it's actually harvested by the end of the insurance period. So a good example would be, think about citrus in Florida or avocados in California. They can, those crops can sit stored on the tree until the grower needs to sell some. They'll just continue to grow. Avocados will sit there and they'll just get bigger, and same thing with citrus. They may have been ready and typically harvested in September, October, November, but due to market situations or the supply is such that they leave them on the trees for a little while and maybe not pick them till January or February. So, but they were ready back in September, October, November. So that's what that little piece is really talking about. And if they're held over to January, what does that mean? What are they now? They're now inventory, and we have to go out and look at how much inventory is being stored on the trees. So just a thing to keep in mind there. Whole Farm was developed to provide coverage for farming operations that are highly diversified and grow commodities that often don't have individual crop policies available. Just covered that a little bit. And it operates on an accrual basis. So those of you that know a little bit about have an accounting background know what the difference is between cash and accrual. It means basically what we want to do is we want to go back and account for what actually happened in the year that it happened, rather than when we received the cash for it. So you're thinking back on those oranges, what happened in the year that they were considered produced. So let's just say 2024, let's just use that, and you didn't sell them till now. Well, we want to go back on an accrual basis, and that's why we use in our accounts receivable and our accounts in our ending and beginning inventory. So that's what those forms actually function to take care of, is that accrual accounting. All right, so eligibility for whole farm. And we'll get to the microfarm eligibility requirements towards the end of the program, since whole farm policy is the basis for it, and then the microfarm is an endorsement on top of it that has some unique features. So the qualifying person criteria and insurance eligibility. First of all, need to be eligible to receive federal benefits, probably meeting a social security number and those type of things. Be a U.S. citizen or resident. File either a Schedule F tax form or other tax forms that can be converted to a Schedule F. Talked about that a little earlier in the presentation. And be engaged in the business of farming and derive revenue from the production of commodities. The Schedule F or substitute Schedule F must cover 100% of your operation. So occasionally we get some questions that come in every once in a while. A tax entity, so some folks have a couple of different LLCs and things like that don't necessarily represent the entire farming operation. So we want to make sure that we have that your Schedule F or your substitute Schedule F covers the entire operation. So because an entity that does report a fractional share of the farming activity conducted by, say, a partnership, a corporation, or any other joint venture does not qualify for whole farm coverage. So if you have 3 partners sharing in a farm operation, it's the partnership that takes out the policy, not the individual members. Also, derive not more than 50% of expected revenue from your commodities that you purchase for resale. So if you're a direct marketer and say 80% of your business is resale, that would disqualify you from being eligible for this product. Continuing on, criteria and eligibility. So there's some limitations. Ineligible if the insured revenue, and this is under the whole farm revenue product. This is the full blown product. is 17 million on the sales closing date. Now, notice that it says insured revenue. So let's say we're at a 60%. My math's not very good, but 17 million is 60% of some bigger number. So that's how that works. Commodity count equals 1, and potatoes. This was something that the potato growers out in Idaho got put in the Crop Insurance Act years and years ago, the predecessor to the whole farm product. This got in there. People ask this question all the time. Why can't we grow potatoes and get whole farm? Well, that was put in the Insurance Act years ago, and so that's the short explanation of it. Revenue protection is available under another FCIC reinsured policy, say the wheat policy, wheat revenue, for the commodity with an expected revenue that equals or exceeds your qualifying revenue threshold. I don't know if we get that deep into the weeds in this presentation, but essentially, if you have a commodity like corn and it's your predominant commodity, and you have a couple other little cucumber patches or something like that, but the majority of the income comes from the corn, and the revenue from the cucumbers is so insignificant, then that would be a consideration to make in your commodity count. The farm operation includes any revenue from controlled substances. If you're growing what we call the marijuana versus hemp, that would make you ineligible because it's not a federally approved crop. Regardless of what state you're in and the legal status of it in that state, it just doesn't matter for a federal program. All right, so getting into this, and I believe the whole farm page on RMA's website goes into this as well. But this is just some information, keep in the back of your mind as far as the limits of coverage. We already talked about the $17 million insured revenue, and that equates to a $20 million expected revenue at the 85% coverage level. Speaking of coverage levels, it's from 50% to 85% and 5% increments. And I would think that if you've been through some of the prior fundamentals of crop insurance, you've covered the coverage levels. And what does that mean? In other words, at the 85% coverage level, there's a 15% deductible. One commodity, there's no restrictions unless one commodity using the commodity count calculation is potatoes, or the commodity has an FCIC revenue product available. Just touched on that a little bit ago. Animal or animal product limits, expected revenue up to 2 million. Now, this is where we have to be real careful where we're splitting hairs. There's a difference between expected revenue and insured revenue. Expected revenue, if we go back up to the liability limit, is at $20 million. So if we've got expected revenue of $2 million of livestock sales, then we're good to go. Anything under that is good to go. Same thing with nursery and greenhouse. And then replant payments on the whole farm, we don't have them on microfarm, is up to 20% of the expected revenue for the annual commodity. So if you expect $50,000 on, say, canola, then whatever 20% of $50,000 is the maximum replant payment that you could receive for that canola. And it's calculated actually on an acre basis. So each acre has an expected value, and then 20% of that expected value per acre is what the replant payment could be. And you have to qualify, an insurable event has to occur, that type of thing. Probably don't talk enough about what insurable events are, but I think we'll get into those later. So FCIC coverage is optional and may be at any level, including catastrophic level. Talked earlier about having other crop insurance policies, whether it be wheat, soybeans, barley, canola, camelina, whatever, dry beans. You can have those policies in addition to whole farm. Any indemnity that's payable under those becomes revenue to count under this policy, and we'll talk about that. We can't, one of the principles of insurance is not to over indemnify or double indemnify for the same loss. Just a little insurance background there for you. Market readiness amounts and insured revenue, yes, we've covered that already. Expanding operations. If your operation is growing, there's a way to increase the guarantee as we go along, because if we think about, and we'll get into this later, you've got a history of producing, say, $50,000 in revenue. This year you expect to grow, maybe expand some land or add a plot of land, and now we're going to grow $80,000 in our expected revenue. And the policy has a mechanism in it that says we're going to insure the lesser of your expected revenue or your historic revenue. So in that case, our historic revenue would limit our amount of coverage, and we wouldn't be truly insured for the increase in our operation. So this is just a mechanism that allows us to kind of capture that expansion. Cancellation termination dates, these are when the RMA has to have changes done for the policy. That gets kind of technical. Contract change date, that's August 31st. So when RMA is looking at the policy, they have to have any policy changes done for the crop year by August 31st. Sales closing date, depending on where you are in the country, if you're way far south, down the tip of Texas, it might be January 31st. You move up further north, it might be February 28th. And then generally for the rest of the country, like here where I'm at in a suburb of Kansas City, it's March 15th. And then we all know, maybe you have a different filing schedule, maybe you're early fiscal year filer or late fiscal year filer, then that can change. Those sales closing dates can change to accommodate those situations. And then the rating methodology in the actuarials, when you get on the RMA webpage and you get in there and you look at the actuarial information browser and you get to the special provision, and it has a commodity listing. I don't know how many commodities they have, 128 or something like that. And there's some different groupings to accommodate similar crops. But every one of those listings has an individual rate. So if you've got some cut flowers that you might have on one line and you have some hemp on another, those are going to get rated differently according to the expected revenue that you have. Each one, because each of those crops has a different risk associated with it. Some of them are more resilient. Your perishable crops have a higher rate because there's a higher risk associated with those and that type of thing. The subsidy level, what does this really mean? It means, what does the federal government contribute to the premium cost, the true premium cost? So let's just look at the single line there. It says subsidy qualifying commodity count of 1, and we select the 80% coverage or the 50% coverage level. And the federal government's going to contribute 80% to the cost of the premium for that coverage level. And if we go all the way up to 85% coverage level, the federal government's going to contribute 53% to the true cost of the premium. So when you get a premium bill, when the premium billing date comes, you're going to see what the total premium is, what the federal contribution is, and then what your contribution is. So that's what that slide is trying to tell you. And the commodity count is not applicable to microfarm because it's just, and we'll get into that. Microfarm groups everything together as if it were one commodity. We get a total amount of revenue. So we don't have to worry about commodity counts when we get there. And you notice the second line in that chart is simply showing more diversification. We get a little better bump I mean, especially if you go over there to the 75% coverage level across the top, go down to the two counts, and the federal government contributes 80% rather than 77. So it's just the more diversification, the less risk. So eligibility for premium subsidy, we want to be compliant with the highly erodible land conservation or wetland conservation provisions. And this is just something that's standard to federal crop insurance. And the one thing, the takeaway here is if you're thinking about purchasing this product or any federal crop insurance product, go to the FSA office first and ask what kind of requirements do I need to meet prior to being eligible for federal crop insurance on the risk management side of things. So they'll talk about things like an AD 1026 and things like that. And I'm not an expert on what the requirements there, what types of operations are exempt from this, if any. And I've talked to FSA folks at some different meetings, and they said, the best way is just ask the producer come in and talk to us, about compliance with these type of regulations. So that's all I'm going to say on that slide. So the insurance cycle, this kind of walks through what are we going to do? We're going to compare just standard federal crop insurance. Maybe you've already seen something like this. The intended acreage report, if you're a new producer or never had crop insurance before, you come in and to the agent and you say what you're going to report. On whole farm, it's the intended farm operation report. How many acres? What are you going to grow? How many head of livestock? Are you growing goats or emus or that type of, any type of livestock? And then I talked earlier about being able to revise the farm operation report if you're planting changes, your planting intentions. And then the final farm operation report, that's basically your production report at the end of the year. You say what happened on the farm, that type of thing. So, and then below, just on a perennial, if you've got an apple orchard, pear orchard, peach orchard, apricots, whatever, and the acreage hasn't changed, then you can basically come in and just do the three reports. The insurance cycle, let's start in the upper right-hand corner, like if we're going from noon to 3 o'clock. Let's do the application. Go in, talk to the agent, apply for it. That goes through the verification process at the home office. And then for acceptance, and then if it's accepted, then we arrive at an approved revenue. So the whole farm history report and the initial farm operation report are due at this time in this quadrant. Then once we're going through the year, come July, whatever, we get our summary of coverage and our premium billing statement. And that's premium is determined from the revised farm operation report. So you come in July, typically July 15th is when those are due, is what actually did you get planted? Did you have any replants, that type of thing? And then we're going to have that report, and that's going to be from which premium is determined. And then going over here from 6 o'clock to 9 o'clock, this is the end of the year where the final farm operation report is completed and turned in. And then funny thing with whole farm revenue protection is we do not file a claim until the taxes are filed for that year. So that's one of the big differences in this program versus the other. It's using the Schedule F, what you report for taxes, is kind of a proxy for what the revenue production of your farm is. And until we know what that is and what you report on your taxes, once that's done, then you can file a claim. But I don't want you to think that you can go through the entire year, wait until you file a claim, and then just file a notice of loss and for something that maybe happened back in the prior May. Anytime that there's a loss or a event that occurs, you need to contact the insurance company and let them know. It's just like your car. You don't go out and get a fender bender and then wait a year to turn in a claim. You want to make sure that you tell the agent right away, you get that thing settled and move on down the road. That doesn't mean that in the whole farm policy you'll get a payment because nothing shows up until after you filed your taxes and done the claim at the end of the year. But you still want to make sure that the insurance company can track what has happened. So understanding the role of the IRS Schedule F in whole farm. So let's get started with identifying all this upfront documentation that we're going to need, beginning with the IRS Schedule F. Whole farm uses the information from the Schedule F that is completed and filed with the IRS each year to form the basis of the whole farm coverage. For entities or farming operations that don't file tax forms, I've said this before, requiring the completion of Schedule F, information on those forms filed will be used to complete the substitute Schedule F or to qualify for coverage. So it's important to understand that the coverage under this product is not established solely on the revenue reported on the Schedule F or the substitute Schedule F. That's kind of something that you need to go in and understanding that. And the thing that I always try to understand with the Schedule F is you're managing your tax liability. You might have some grain that was held over from one year to the next that you don't want to sell it in the prior year because you don't want to pay taxes on that until next year. So and kind of maybe level out the revenue stream, that type of thing. So the Schedule F is kind of a starting point. It's not the end all be all. We're going to make some adjustments to that. Again, this is the accrual accounting aspect of this product. So whole farm ensures the revenue produced or purchased for resale during the policy year. We talked about the oranges, for example. The Schedule F may include revenues from the prior years, and it is not included in revenue for commodities produced during the policy year. When we say the policy year, that's the year we're in. So right now, we are in the 2025 policy year for a calendar year filer, so to speak. Because the Schedule F may not be representative of all the revenues attributed to a policy year, we're going to do the accrual accounting. And so that's enough of that. Let's move on to the next slide. So how we determine coverage. So before we go any further about what information goes on our farm operation report, let's discuss how it fits in the determination of our coverage. The whole farm insured revenue is the lesser of the whole farm historic average. What did you do in the past? Or the expected revenue that you put on the farm operation report, the 4. And that's going to be multiplied times the coverage level. We talked about coverage levels from 50 to 85% and 5% increments. So we're going to do all of that mathematic gymnastics and upfront and come up with a guarantee. So again, making sure that you're letting your agent know about your farming operation. Is it experiencing an upward trend in revenue or has recently had a net increase in production capacity by adding land to the operation? So consider the implication of not being able to capture an expected increase in this revenue if your farm is growing. We're just leaving something out there not covered for you. So we want to make sure that we've done all those things, keep our agent informed. So establish the expected revenue. So now that our whole farm history, beginning accounts receivable and beginning inventories are established, we've done all that information gathering. The expected revenue from commodities produced or purchased for resale on the farm needs to be established. This is completed, believe it or not, through another form. And that's in the case of the commodities held for further growth and development. For example, livestock, there are more forms to complete to establish an amount of revenue from the expected growth of the commodity. So we have a steer out there and it was born, let's say it was last May, and it's going to be a yearling here come this May. Well, we're only going to look at the beginning of this year as what its established weight is. What do we expect it to be at the end of the year? Or when do we expect it to sell and what weight's it going to be at? So we're only going to talk about that time period from the beginning of the policy year to when it is sold. And if it's going to be carried over to the following year, then again, that will become an ending inventory, and we'll jump into that a little later. Those of you that have livestock know all about that kind of stuff. So the farm operation reports like an acreage report under a traditional federal crop insurance program. The commodities that are insured are identified. The amount of production per acre is established, and the unit of measure is entered. Are we talking pounds, boxes, crates, bushels? What are we talking about? Hundredweight, in the case of hay, that type of thing. For livestock commodities, we're talking about the number of head expected to be produced or the amount of weight gain expected. And that would be entered in pounds. And to document the basis of numbers and amounts entered, there's a form called an expected value and yield source documentation certification worksheet. I believe I have copies of those later in the presentation. So we're going to record the source or the sources used to establish our prices and yields. We're not going to just pull these out of the air. Some of you might be familiar with the commercial by Progressive where it's name your price. Well, that's true to an extent, but when they say name your price, then there's adjustments, whether that be the deductible, your coverages, how much things, there's going to be changes. So it's name your price to a certain extent, but we're going to verify that and make sure it lines up with established markets and kind of have some sanity checks to it. All right, so moving on, the farm operation report. This is the big one. This is the one that just captures everything. It has three sections. There's the intended section. This is the part where we put down what we expect to produce, how much we expect to get from it, and that type of thing. The second part, again, talk about this a little bit later, completed by July 15th. And if you're a fiscal year filer, it might be a different date, but for the most part, July 15th is when we come in and what did we actually do on the farm? And then finally, the purpose of the revised section is to report any changes to the expected quantities. So here's what it looks like. So there's the three parts in green. So you can go across there. I'm gonna take a look here. The farm operation report is completed every year to report the commodities intended to be produced, along with expected values and yield, and a revised section to capture what was actually planted, and finally a section to capture at the end of the year what happened. So that's what that form looks like. And it's one of those things that if you're in the farming business, it's probably a good exercise if you're not doing it, just to sit down and look at something like this and just, I mean, this is kind of a neat tool. I had to do this in 4-H when I had show steers, part of the process. And FFA had little books and things that we went through and how much do you expect to feed and that type of thing and how much did you actually feed and what was your rate of gain and cost and all that stuff. So just kind of a different way to look at it. Farm operation report revisions. Again, be sure to explain to your agent why the revisions on the farm operation are needed. Was the revision necessary because the first planting of the quantity was lost due to a peril or et cetera, or a management decision? So we got to make sure that we're keeping the agent informed. The revised section will also capture changes, and we've gone over this time and time again, but redundancy is sometimes a good thing. So I want to make this clear that for changes that occur after the revised farm operation report date, that's that July 15th, anything that happens after that date, you are required to notify the agent within 30 days of the change. That's probably just a good course of business. As soon as it happens, tell your agent, pick up the phone, send an email, whatever. So, and I've got a little example here. You intend to purchase 50 feeder cattle in August and was reported on your revised farm operation report. However, instead you purchased 75. 25 more than you intended, failure to notify the agent of the cattle not being included in the expected revenue, and the revenue earned, whether sold or not, will be considered revenue to count. So that's why you want to tell the agent what's going on, because if you don't and you realize some revenue from it, it's basically considered uninsured and it gets counted against your claim. So keep the agent informed. Can't say that, stress that enough. Again, farm operation report. And this happened back in the 23 policy year. The policy was enhanced by replacing the existing expense reporting procedures with a 40% reduction. So if you haven't had whole farm before and count yourself lucky from those early adopters, because they had to also report all of their expenses. So it was quite a burden, and RMA has come up with a different way um, to address maybe not getting everything planted. Because if you didn't realize the revenue, 70% of your expected revenue because of commodities you didn't get planted, it started knocking the coverage down a percent for each percent that it was under 70%. So this basically it operates similar to prevented planting under other policies. So it kind of gives you a 60% plug. So it's not such a harsh penalty. Expected value and yield source document. This is essentially a document that says what are the sources that are you're basing your yields on? Maybe it's just your history. This yield and source document is the form that we're used to document the source reported on expected revenues and yields. Commodities having different markets maybe need to be reported on different lines if there's significant differences in values. Maybe you're delivering apples to a cider market and one to a fresh market. Those are definitely going to have different expected values. Again, this product has experienced several different enhancements since its inception. And one of those enhancements was to providing reporting direct marketed commodities as one amount. So if we've got a bunch of different specialty crop commodities we're delivering to the market, maybe we got 15 different commodities, and it's very difficult to keep all of those separate. Well, we can say, well, we took so many pounds of produce to the market. We expected to receive, $10,000 this weekend, and so we put that down as $10,000, and it's going to be one commodity. It's going to be called direct marketing. So if you're looking at that document, it says commodity name. We might have wheat, corn, and then we might, for those things that we take to the farmer's market, we'd call that direct market. Yield and revenue report. This is a report that's used to report the yield and revenue history for the commodities insured under an individual yield or ARH policy. That's the actual revenue history product. That's not too wide. It's for maybe cherries, strawberries, and I think there's something else on the East Coast you might have run into if you're out there. So this is similar to what the actual history report is, production history report under the other plans are. So we'll just kind of get a background on what your production history is and your yield capabilities. Pre-acceptance worksheet it's required each year before the beginning of the insurance period for all commodities identified as a perennial. And on that commodity listing under RMA's page, it'll say whether they consider a particular commodity an annual commodity or a perennial commodity. Pre-acceptance and perennial crop inspection report is required when you answer any yes to any of the questions on the previous form. So this will go and get into a little more detail about what recovery is out there, any disease control measures that need to be taken, those type of things. So like most forms of federal crop insurance, a historical look at our farming operations necessary to establish the production capabilities. And other individual coverage policies would call this actual production history For whole farm, it is referred to as the whole farm history. And to establish this history, the whole farm adjusted historic revenue, the policy requires that we have, and this is the first time we've mentioned this, requires 5 years of tax records to be provided to complete this history report. It's important to understand which years of the tax forms make up this history period. So let's look at this a little bit. This is for the whole farm history report period for whole farm. So you can see the years there. The current year is 2025, the year of insurance, and there's a lag year for the 2024 lag year. So when we came in and we signed up for this policy, chances are we may not have completed our 2024 taxes yet, but we will have our taxes for 23 through 2019. So that's why there's that lag year. Hope that's hope that's clearer than mud, but that's kind of how this works, and keep that in mind. So this is the history report. This is what it looks like. So what goes on it? We know from earlier that 5 years of tax records are needed to complete this report. Working with an agent, each year of the history period will have a determined allowable revenue entry, and that's what's in the blue box. After all 5 years are completed, the average allowable revenue can be calculated by adding the respective columns and dividing by 5. We just get a simple average. The last 3 rows of the form are used to capture an upward trend in revenue. So if there's something going on that things are increasing, it'll capture that, and there's some calculations that behind the scenes that go into it. I mean, it's not really behind the scenes, but it gets get into the weeds and you can find them.
So Dean, we've had a question,
Oh, okay. Thank you.
somebody said, asked, Schedule F is usually cash and the policy is based on accrual. How is that going to work then if somebody's a cash basis taxpayer? Um, how do those things get remedied, I guess, from, moving from a cash basis Schedule F to policy being accrual?
Yeah, the on a cash basis there, you're probably selling things as they come in. And when we talk about accrual, it's making adjustments at the beginning or the end of the year for any commodities that might be carried over in storage, or you have some accounts receivable outstanding that you haven't received payment for.
Okay.
Because
So
that's how that works.
So you're making some accrual adjustments. You don't necessarily need to be a totally accrual, but you need to keep track of these inventories so you can make those,
Right.
you can account for those. Okay. And one other question that came up was looking at this, it says 5 years of history. So if you don't have 5 years of history, you're not eligible to sign up for these products?
There are some exceptions to that, and I think we'll get into those a little later.
Okay, thank you.
So, yeah, the microfarm, I think only requires 3 years. So, and we'll get into that. But there's some allowances for beginning and new farmers and things like that that are in the policy. But generally, the rule of thumb is 5 years of tax history to get started. So,
Thank you.
all right, very good questions. Very good. I like the engagement. So now we've established the history period. What's next? A couple of things the agent will need to identify from our determined history. First, is the history trending upward? Does it qualify for indexing? And this is one of those things where we only qualify if we do have the 5 years of history. So it's just one of those things RMA built into the policy from a risk perspective is indexing. And the indexing is just kind of, are we seeing an incremental increase from year to year? Or secondly, are we looking at an expansion? Did we add some more land? Did we add another greenhouse? Things like that, where we can expect more revenue. And we want to make sure that we're capturing those. This policy needs to grow with you as well. We try not to, RMA has made significant strides trying to make this policy not be static. where it takes a point in time, grows with you. So let's jump on to this. Now, this is a document where we take the Schedule F information and plug it into this form, and this is where we make some of our adjustments. So a couple of concepts we introduced earlier is that the whole farm needs to be explained, a history that needs to be explained to the agent, and it all begins with determining our allowable revenue. So this is the form for determining allowable revenue. So for each year in our history, we're going to fill out one of these documents. So it's kind of scary that first year because you're going to fill out 5 of these or however many you qualify for, maybe 4 if you qualify as a beginning farmer, veteran farmer, that type of thing. But once you get this history established, going into next year, you're only going to have to do one of these. But that first year is the big one. I, there's no way around it. I apologize. I wish there was a shortcut, but there just isn't. So the ending result for this year is we're going to transfer that history from our Schedule F to this report. And then remember earlier that it was stated that Schedule F is not a profit and loss statement. I think you all know that it shows a tax liability, but it doesn't have any relationship to whether you made a profit or loss on your farm. It might be an indicator, but there's things that we do, might hold stuff back in inventory, that type of thing, that it's not counted in there. So we might show a loss when we actually really had a profitable year, those type of things, and vice versa is true. So for that, there's just, an agent just can't simply copy the amounts entered on your Schedule F and just, we're going to write an insurance guarantee for you. So allowable revenue is the farm revenue specified by the policy and included in applicable adjustments from the production of commodities produced by your farm operation, purchased for resale, purchased for further growth and development by your farm operation. So that means simply went out and bought some feeder calves and you're going to feed them out. That's further growth and development. And that the IRS requires you to report on your farm tax records. What are the applicable adjustments and what revenue items are allowed? We'll look to Section 10 of the policy, and that begins this discussion of our of allowable revenue. So hopefully now I made it abundantly clear that to complete the whole farm history, that the agent is going to need more than just your Schedule Fs. They're going to need documentation to support what the basis for each of the revenue amounts entered on the Schedule F are. So let's talk a little bit about replant coverage. We've talked about some of the forms that are going to be needed up at the beginning. So we're kind of progressing now through the insurance cycle, and we want to, before we move on to the claim process, it may be necessary to replant a commodity. Happens. It's damaged anytime during the growing season and requires replanting. Whole farm offers replant coverage if it's necessary due to an insured peril. Yes, there's a worksheet for this too, and it needs to be completed before a replant payment is requested. To qualify for a replant payment, the commodity must be an annual plant. We're not going to replant apple trees under this program. I think there might be another product, an apple tree program that's coming along. I think we've already got one. Or citrus tree, things like that. So there are products for those. And the commodity cannot be covered under another federal crop insurance product having replant. So if we have wheat, there is a yield protection policy, revenue protection policy out there for wheat, and it does provide a replant payment. We cannot get a replant payment for a wheat if it's in a county that's insurable under that other FCIC product. Okay. What are we going to cover? The amount of available replant payment is the lesser of 20% of the expected revenue times the coverage level for the commodity reported on that farm operation report, or the actual cost of replanting per acre. So it's kind of a balance there. So we got a limit on it. Again, we just touched on this. It's based on accrual accounting at claim time. Persons using the accrual accounting method generally report revenue in the tax year it is earned, whether it's been received yet or not. Accrual accounting allows the person to match revenue to the year in which revenue was earned. So this is probably an exercise that you go through whether or not you know you're making money in a year or not. So I mean, it's one of those things you need to do. Am I making a profit or am I not? A farming operation in a year will have outstanding accounts receivable, possibly unsold inventory, either on the farm or in third-party storage, delivered it to the co-op or whatever. Or it could be a commodity that remained in the field. We talked about citrus earlier, where it's reached a mature stage and it's just simply being stored on the tree for next year, delayed harvest. So here's just kind of laying those forms out like a stack of cards. You can see them there. We've got, what do we have? We have our allowable revenue worksheet, accounts receivable, market and animal nursery inventory report, and an inventory report. So we've got them all there. All right. In addition to completing and including with the application your whole farm history report and the allowable revenue worksheet, all of these other worksheets, an accounts receivable worksheet will need to be completed and included with the application. All of these things are needed up front. You need to get a picture, true picture of what's going on your farm, and that type of thing. These reports are not required to adjust allowable revenue for each year in the whole farm history report. So what we're really trying to say is you've taken your Schedule Fs, you've gone into your history reports, and you've put all that information in there. We're not going to ask you to go back and do an beginning accounts receivable and ending accounts receivable for all of those 5 years. We figured everything's going to average out in that time period, and it's just not worth that exercise. So that's just a lot of unnecessary work. So the policy does not require you to do that. I hope that came across good. I know it's a lot of technical detail, but that is one thing that the policy does not ask you to do. The document identifies revenue that was earned or incurred in the prior years. Again, I've talked enough times about delivering things to a processor, maybe not receiving payment yet. That's an accounts receivable. We need to note that. Beginning and ending inventories, same kind of thing. Talked about the cattle example earlier, where we've holding over our May calves to next year, or maybe we've just had some calves born in October, but maybe we're going to sell those to somebody else come March. But we still need to have a beginning inventory of those and an ending inventory. Account for market animals and nursery inventory, same kind of thing. It's just another form. Gets into the weeds here. We're going to value those market animals and nursery inventory at the beginning of the insurance period so we can track the gain in the value of the commodity during the year. We need to get a starting amount, and then the ending amount, whether that's sold or at the end of the year. So that's, and in nurseries, might have plants that are carried over. So notice a loss. This is very important. Anytime during the policy year, anytime there's a loss, you can report that within 72 hours of the discovery of the loss. That's pretty critical. The company must be afforded the opportunity to inspect the damaged commodity. For example, let's just assume we have 100 acres of wheat that was damaged by hail and was harvested without notifying the company. The company was not afforded the opportunity to document that the loss occurred and to what extent the damage reduced the revenue potential on that crop. The company will therefore have to assume in most instances that the loss of revenue from the wheat was due to uninsured causes. The loss of revenue from uninsured causes is considered revenue to count for claim purposes, And remember earlier, an increase in revenue to count is a decrease in the potential indemnity. So at the end of the year, when you file a claim, all the revenue that was earned or received in cash, we're going to add all of that together. The ending inventories, we'll get all of that, subtract our beginning inventory so we can get the change that occurred during the year, the gain. And that's going to become our revenue to count. And if the situation occurs where a loss was not did not notify the agent of the loss and the adjuster couldn't come out and verify it and the harvest went on, we're just going to assume that you got the full expected value of that crop, and basically it's a wash and no claim payment for that portion of what it would represent in your revenue. Uh, I guess we'll go back and one thing to make clear, if the price of, say, you're growing wheat and the price of the markets keeps moving up and down, you're not required to report that. Just things that happen to the crop. Did it hail? Did it flood? Was there disease? Did animals get in it? That type of thing. So those are the type of things that you want to make sure that you report. Claim submissions. Before a claim for indemnity can be submitted, the farm taxes must be completed and filed with the IRS. Claim must be submitted to the company within 60 days after the earlier of the date the taxes were filed with the IRS, or the original date the farm tax forms for the policy year must be provided to the IRS. So, I have to sit down and read this section of the policy every time to get it clear in my mind. What in the world are we talking about? But let's just make sure that when we file our taxes and we think we've got a claim, let's just get it done and don't wait around. Now, there are cases where an extension can be filed or may be filed. May be necessary for you to file a extension. In those instances, taxes must be filed on or before the first day of the 7th month after the end of the insurance period if an extension has been requested. The end of the insurance period for a calendar year filer would be December 31st. So 7th month is July. If an extension has been requested, the claim must be submitted no more than 60 days after the earlier of when the taxes were filed or the extension due date. Extension must have been filed by the date required by the IRS, and a copy of the request for the extension must be provided to the company. Request that the IRS send the company verification of the date the return was filed. So just a couple of things there. If I wouldn't worry about them unless you file an extension, then I would suggest you go sit down in front of the agent and go, okay, what do I have to do? So that go see the agent if in question. Other adjustments for claims. What other kind of things are we looking at? Because this policy can be purchased along with other individual federal crop insurance policies and receive a liability credit that reduces the whole farm premium. This is that umbrella concept where the underlying policy, that wheat policy per se, becomes primary insurance, and any indemnity due under that can be revenue to count for whole farm, because we're going to take that liability of that wheat policy and reduce the amount indemnifiable under whole farm and reduce our premium on whole farm. So it's kind of once you learn the ins and the advantages of this product, when you're using it as an umbrella, it becomes very useful to kind of give you some of that top end coverage. The other thing it does is in canola, I believe, does not have a replant payment. So if you're in the Northwest or Montana where they grow canola, those folks will insure their canola under the federal crop insurance policy, and they will have this whole farm policy sitting on top of it that provides replant coverage. So there's a whole kind of different things that this product can be beneficial for. other than just its standalone properties as you understand it. So that's why it's important and imperative that you talk to the agent about, your farming operation. What do you got? What are you doing? What's your expectations? What are your practices? Are you an organic farmer? That type of thing. What is your organic plan? What does it say that you need to do? What are the farming practices that you're following that are considered acceptable? Because under any policy, federal crop insurance policy, um, good farming practices, whether it be for organic or any other type of farming practice, one of the things that with the agreement that the insurance companies have with the federal government is to ensure that they're not paying indemnities or claims for failure to follow good farming practices. So keep the agent involved, make sure you're providing the documentation of what your plan is and those type of things. And it won't be a surprise when we get to this point in the process. In the last step in this cycle, we talked about the farm operation report, and it was noted that there are 3 sections. This final section, aptly named the final farm operation report, wraps everything up, and it needs to be included along with the claim for indemnity. So, and if you fail to do that, the following year, you'll still be eligible for coverage, but we're going to limit you, or the policy limits you to a 65% coverage level.
Would a CSA, community supported agriculture kind of operation be able to be supported under this kind of policy?
No,
No. Okay.
because the risk is being assumed by those that are participating in the CSA.
Okay.
Yeah.
All right. And then we have some people that have pick your own operations. Are
Mhm.
those covered?
Yes.
Okay.
It'd just be like anything else. What is the revenue that you expect from that? So, you let folks come in and pick the apricots. How many, what's the bearing fruit of each tree, and you come up with an expected revenue. And
Okay.
if you only expect that 80% of the actual fruit's going to be picked, or maybe 90%,
Mm-hmm.
you want to make sure that you factor that in. It's same thing. And I didn't really talk about this, but if you're a livestock operator and you're raising livestock, you probably have a history of, oh my gosh, I forget my terms, but the mortality rates. If your mortality rate is 97, 98%, you might have 100 heifers or cows, but you only expect a calf from 98 of them. So those are the kind of considerations that you need to keep in mind, is
Okay.
what your expectations are.
So you don't have to weigh the kids in and out if you are doing a strawberry pick your own then.
Right.
Okay.
Well, I mean, you probably should be.
Okay. One last question. We have some people that are involved in cut flower production, and they sell to multiple outlets. Would all of those fall under kind of I mean, first of all, are they covered, and would they all fall under direct marketing then as kind of one whole, or would that be split up? Um,
Yeah, if it's such that, I mean, there's a commodity called cut flowers on the commodity listing in most counties.
okay.
And so, again, post-production, we're looking at just what's the value of the cut flowers
Okay.
and not what the value is after they get into the vases and arrangements and things like that.
Okay.
What's the wholesale, or not the retail, but the wholesale price of those.
If they direct market, let's say at a farmer's market, and they do bouquets,
Right.
that would be at a retail price, right? Rather than a wholesale price.
Yeah.
So,
Yeah, that's kind of a difficult one. What was the value of those flowers, when they're removed from the field, the greenhouse, whatever?
okay.
What's the price there?
Okay. Yeah, it's just kind of an interesting thing. I know I'm not trying to play stump the expert here but we're getting more and more people that are involved in these a wide range of specialty crops. And
Right.
so it's interesting to learn more about how they might help protect themselves.
Yeah, and those are some fine lines to keep in mind when we move into the microfarm side of things here. It has lesser ceilings for coverage, but there are some differences that allow for some of those post-production operations. So,
Okay, so maybe
uh,
we should let you get into that and then,
yeah,
okay, thank you.
microfarm. So what makes it different? Well, coverage limits. So microfarm is tailored for any farm up to 350,000 or 400,000 for a carryover insured. All a carryover means is that the individual was insured in a prior year. We're not new to the program. So any farm with up to 350,000 in revenue from agricultural commodities, including farms with specialty or organic commodities, both crops and livestock, or those marketing to local, regional, farm identity preserved, specialty, or direct markets. Um, it attaches to and made part of the whole farm provisions. Like I said before, it's an endorsement. And just remember that whole farm allows for $17 million of insured revenue. So quite a bit of difference there. So it's targeted more for specialty crop, you know, operations and that type of thing. So the eligibility kind of have some similarities, but slight differences. Uh, the eligibility under the whole farm policy applies because the microfarm provisions is simply an endorsement. But for microfarm, to be eligible for insurance under these provisions, you must have 3 years of consecutive tax records, including the lag year. And we'll have a little chart on that. Remember, whole farm is 5 years. Your farm operation must have an approved revenue of $350,000 or less. And again, that approved revenue is different than insured revenue. So 350,000 is the cap. If you're a carryover insured and your farm operation has an improved revenue of $400,000 or less, so we're there in that second column. Finally, if you no longer meet these eligible requirements, if you go like during the year, you go above those limits, it's going to be capped. So say you acquire some land or whatever halfway through the year and we jump up to $500,000. Everything gets stuck at $400,000 and anything that's is revenue is received, it becomes revenue to count. So just want to make sure that everyone is aware of that. Just a little difference here. Again, this is a similar thing we saw under whole farm. Prices, commodities are not assigned individual prices. We have that one commodity approach to this. We have a one value per acre that we establish for the entire farm operation. So you have 25 acres, you expect say $250,000. And we're going to, what do we got? What did I say? 25 acres, what is that? $250 or whatever per acre. That's bad math. Anyway, so we're going to come up with a value per acre that we're going to utilize on our farm operation reports. Replant payment is not offered under microfarm. One drawback to it. I just don't know how that could be administrated effectively. I think that was RMA's viewpoint on that. Other federal crop insurance, can you have other policies? It's optional and maybe at any coverage level. So yeah, you can insure, say, the dry beans or canola under another policy. Market readiness and post-production amounts in insured revenue. We just talked about this. And yes, we don't have to stop at the farm gate. However, revenue from sources such as bottled water or souvenir sales must be removed from the allowable revenue because it doesn't represent revenue from the production of those commodities. Now, I might add here is that if you are including those, say we're growing strawberries and we put it into jam and we're selling jars of jelly at the farmer's market and we're ensuring the value of that jar of jelly, it's one of those. If you can separate the cost of the strawberries coming out of the field versus the jar of jelly, it might be to your advantage to do that from a premium perspective. And I only say that because if we're only insuring the fruit at that value, that means that we have less liability, less premium outlay, and it may be such that if that kicks you over that liability limit of 350 or $400,000 and you can separate those out, it might get you under that cap. So just a couple of things there to keep in mind. Expanding operations, the indexing procedure that we talked about earlier is available, but there is a catch. There is the requirement for 5 consecutive years of revenue history. So there is a catch there. It allows for up to 35% growth over the historic average using physical expansion only. It means, are you adding some land to the operation, those type of things, expanding greenhouses, what have you. Cancellation, termination dates are the same as the sales closing dates, no different than whole farm. Contract change date is the same. Sales closing dates are the same. Premium subsidy will be based on the coverage level selected. We're not worried about a commodity count of 1 or 2. So this is what that subsidy chart looks like. So for example, if you have 80% coverage level on a microfarm, the federal government is going to contribute 71% of the cost of the premium. So that means that the farmer pays 29% of the cost of the premium for there. So that's what that chart's trying to tell us. The history period looks a little different. If you recall the whole farm policy, that 2024 was a lag year. We're going to use that in this program. So this is showing a farm with 4 years of records. And if you have all of them, if you have 4 years of records, it's a requirement that you provide them. If you have 3 and that's all you have, that's all you have, and that's enough to get into the program. But if you have 4, bring them. If you have 5, bring them. The history report, the microfarm history report is, again, provide a substitute Schedule F for the lag year if taxes are not yet filed. So go in and fill out a Schedule F, provide it to the agent for the lag year, because you probably have enough information to do that. It's not part of the whole farm history report on whole farm, but it is for microfarm. So if you have less than 5 years of records available, allowable revenues for years without records are completed by duplicating the lowest of those years. So we still want to get a 5-year history, even though you may not have it. So that's what we're going to do. To qualify for indexing requires 5 years of records. Farm report and expected value. Individual commodities are not required to have separate expected values on the farm operation report. Again, we're just getting a value per acre. 3 years of sales records, which may be certified, are required. Consolidated sales records are acceptable. So this is just providing verification to the insurance company that all of these things match up, and they can substantiate what's being reported when the federal government comes and audits them, because they're your friend. They're making sure that everything, all the I's and T's are dotted and all of that, because the insurance companies are audited by the risk management agency and making sure that they're following all of these things. And the AIP, that's the approved insurance provider, may request sales records that comprise a complete marketing record of the commodities on your farm operation report. So just keep that in mind. Again, it's best just to come in and educate the agent, provide him all that necessary information. And if you're truly paying attention to your profit and loss on your farming operation, you're probably already doing all of these things, and maybe just in a different format. But anyway, again, the farm operation report and the expected values must certify the total planted acres of the same 3-year period sales records are provided. Must have acceptable verifiable records to support the acres certified and provide records to the EIP if requested, and must provide a total value of the insurable commodities for the operation on the final farm operation report. So a lot of similarities, but some very good enhancements that may fit your operation. Expected values of commodities is determined by the previous 3-year under a microfarm minimum up to maximum 5 years average of the allowable revenue from all commodities on the farm, unless we have some market conditions, the commodity mixture changes, or production capacity used to produce the commodities on the farm has changed, such that the total revenue generated on your farm operation is expected to be lower than the most 3 recent years. So if the farming operation is shrinking, or just maybe sold off part of it, we need to know that too. Just like if it's increasing, we need to know if it's decreasing. If the total revenue is expected to be lower, than the expected value of the insurable commodities will be reduced to reflect those market conditions, et cetera, et cetera. So anyway, enough of that. Post-production and added value under microfarm. Again, I touched on this a little bit, what the value of including that is, and maybe what the advantage of not including it is if you can separate out those amounts. But revenue from sources other than insurable commodities, for selling bottled water on the side or some souvenirs, things like that, those are not revenue from the commodity, so we want to remove those. Expanding operations. Under microfarm, it's only the addition of production capacity, that's physical land or structures. I think it's self-explanatory. And then just simply to calculate that expanding amount is just divide the total production capacity in use during the insurance period by the highest production capacity in use during the year, any year in your whole farm history period. So things that your agent can help you out with. And that's my last slide. Any further questions that came in? I know this is a pretty deep presentation, and the questions that I get answered get a lot deeper, but I think this gives you a pretty good overview of the expectations of what the forms are, the coverages. Hopefully I gave you a few ideas or examples that help illustrate some of how the policy works. And just a little background, when I first got into this crop insurance business, I was in other lines, and my father was very inquisitive, or wanted to challenge me on crop insurance, and he was asking me why we asked all of this information. And I said, well, it's pretty simple, it's you're a taxpayer, and when we go out and we want to insure somebody, what are the things that, if you were going to ask your neighbor, if you were going to offer them insurance coverage for their farm, what kind of things would you want to know before you took on that risk? So I just kind of like to leave people with that, and it puts things in a little different perspective of, when I'm talking to my neighbor, and that neighbor wants me to insure him or her, what are the kind of things I want to know about their operation? So
Okay.
I'll leave you with that thought.
Thank you. Thank you, Dean. We have a few more questions if you're open to those.
I am.
So we had one that says, so the micro policy is like a rider on the whole farm revenue policy, not a separate policy. Is that correct?
Yeah, it's an endorsement. Yeah, different lines of insurance would use a rider, but it's an endorsement. It changes. A rider sits on top of a policy. So, like you think of a jewelry policy, you might have a rider to cover a specific piece of jewelry. An endorsement actually changes other terms within the policy. So, like the record requirement of 5 years, the microfarm changes it to 3 years. The post-production operation is not allowed in the whole farm, but the endorsement for microfarm changes it so that it is allowed. So that's the difference between a rider and a endorsement. So yeah, the endorsement attaches to, and so your policy becomes, you still have a whole farm policy, but it's endorsed by the microfarm commodity, and that's the way they like to think of it. So
Okay. So you're going to have a whole farm policy, but you're going to have an endorsement that is microfarm,
right,
and that allows some different things to happen then with the policy, but
right,
then there are restrictions on amount of revenue and things like that then.
right.
Okay. All right. Well, that's helpful to understand. Lots of new terms for some people. I know that insurance in general can be kind of a scary place for a lot
Oh
of
yes,
people because there's a lot of it's kind of a whole nother language and people
right.
find that challenging. Um, so would somebody who is has a free range chicken laying operation, they've got pastured chickens and they raise eggs, are those covered under whole farm policy?
Yes, yeah,
Okay, all right.
yeah.
Um,
Yeah, as long as one of the questions that came in just, what is today? Is it Tuesday? Okay, so it came
it
in
is
last
Tuesday.
week.
Yep.
So a question came in about Christmas trees last week.
Okay.
So, there's a distinction to be made here. Do we just have some forest land that we allow people to go in and cut trees off of? Or are we actually cultivating the trees to produce Christmas trees? There's a
Okay.
distinction there. So if we're in control of the production of the commodity, we're actually producing the commodity, then generally any commodity that you're producing, free range chickens, if you got a control of them, you're going out there, you're managing them, that's
Okay.
insurable.
Okay. But not something like wild ginseng. If you're just going
No,
out and harvesting it, that's not
right.
counted. But if you were cultivating ginseng specifically for markets, then that could be covered.
Yes. Yeah.
Okay.
Right in the heading of the whole farm policy, it says that we're providing insurance for the commodities that you produce or purchase for resale.
Okay. The purchase for resale, so that covers things like you'd mentioned, buying calves and then, feeding them out. But you also mentioned like apples, so you can buy so like if you have a farm stand, you can buy other people's produce and resell that, and
Yes.
that's an acceptable. That was a little surprising to me.
Yeah. I mean, it's, and the whole idea behind this policy was to cover folks with highly diversified farms because there's not a farm or a federal crop insurance policy for every commodity out there.
Right, right.
And it's designed so it will fit a direct marketer or um, folks that have farm stands, that type of thing. And when you go to farmers markets, whatever, somebody might run out of a particular commodity, like, come June, sweet corn's pretty big in this neck of the woods.
Okay,
Um, and
right,
if you brought a bunch of sweet corn and you've run out of it and you need some more, you might go to, a booth across the way and grab some. But, the thing with that is you got to keep in mind, you paid a particular dollar amount to buy that corn off that other individual, and you may only sell it for 5 or 10 cents an ear. Well, 5 or 10 cents is the amount that's insurable.
right.
So you got to
Okay.
remove the basis.
And so, for instance, like a greenhouse, they might seed annuals and perennials that they sell, but they might buy some shrubs or trees from somebody to resell as part of their product offering. And so
Mm,
those would be covered under this as well. So they would have, they would have some coverage for those in case, some nursery stock or whatever that they've lost if there's an issue.
right.
Okay. All right.
Yep. Yeah, and and when you get into those type of situations and those type of questions, just make sure that you're asking those questions. So, come claim time, somebody goes, well, that's not covered. You want to make sure that you get that right up front.
So you had mentioned that these products are pretty much available throughout the United States. Um, does every agent handle these? I mean, and how do you find a good agent, that's going to understand, you said early on in your presentation, make sure that you let them know everything that you're doing. I think it's hard to be, totally knowledgeable about every type of specialty crop and how
Right.
you might do things. So how do you find a good agent or somebody that's going to be able to help you make sure that you've got the right coverage and that you're doing things the right way?
Well, first of all, I'll ask a question, and because I've got my answer, but has this question been asked of anybody of the other presenters?
Yes, yes, we've had the question come up with other presenters. So
Okay. So they've probably covered the agent locator on RMA's website.
yes, we have.
All
Yes.
right. So RMA, and this is one of those things. This is one of those with how do you find somebody that sells whole farm? And RMA went out and polled the companies. And I believe under the whole farm page, they have a specific page to find a whole farm agent. They have an agent listing for that. Now, I don't know, and that's one of the things too, is you may not find an agent in your location. But with today's technology and whatever, an agent can be anywhere. You can get on a Teams call or a Zoom call, whatever, and have a virtual meeting with an agent, that type of thing. So
So I'm not limited if say I live in the middle of Wisconsin and I can't find somebody around me. That's not stopping me from finding somebody that might be in the Kansas City area to
yeah,
potentially, right?
if they're licensed, and that's what that listing for whole RMA is trying to identify is who would be the agents that
That are
service
licensed. Yep.
that
Because
area.
okay. So they can be licensed in multiple states,
Oh, yes.
and so that's so it isn't necessarily that they need to be right in your backyard as long
Right.
as they're
But
licensed in
that's
your
always
state.
best.
Yep. If you can find one, right? So
Yep, yep,
there
yep.
you go. Okay. Any other questions before we let Dean have a well-deserved rest after, I'm sure, a very long day? We really appreciate you being here with us tonight, and really
Thank you.
lots of terrific information. I think this is going to be um, very much something that we'll spend some time and thought on, and it's been a very interesting. Learned a lot tonight, Dean. So thank you, and I hope everyone else has. And we look forward. We'll be posting this on our website, and we'll make sure that we direct people to. We have people that have signed up for a course as well. We're offering a course for those of you that might have an interest. If you go to our website, anniesproject.org, you can see some details about a course that we're offering, and we will be covering some of these issues because we're going to be focusing primarily on specialty crops. So thank you so much. And we've had another comment saying that nice, thank you, Dean. Nice job. I learned a lot. So we
Good.
appreciate that. And I
Well, I
know
hope I hope it's what you were looking for. So,
well, we appreciate it. Thank you again so much. And if I don't see any additional questions, so we'll sign off and with another thanks, Dean. And we have one webinar left. It will be next week, and that is going to be on apiculture products. And so we look forward to that one. And that will be a lunch and learn on Monday. So please check out the website for details on how to register for that as well. Thank you so much. Have a good evening, everyone.